attendees are in listen-only mode.
Welcome and thank you for joining us. The topic of our webinar today is Continuous Disclosure, Hot Topics and More for Non-Investment Fund Reporting Issuers. Presenting will be myself, Tamara, as well as my colleagues Jonathan, Maria, and Ray. We are all accountants in the Corporate Finance branch at the OSC. This is the first year that we're doing the presentation as a webinar only. We'll be sending evaluation forms at the end of the session, and we'd appreciate your feedback on this format. We'll be sending CPD certificates via email after the session as well. Before we begin, I'd like to remind participants that the views expressed in this presentation are the personal views of the presenting staff and do not necessarily represent the views of the Commission or other Commission staff. The presentation is provided for general information purposes only and does not constitute legal or accounting advice. Information has been summarized and paraphrased for presentation purposes, and the examples have been provided for illustration purposes only. Responsibility for making sufficient and appropriate disclosure and complying with applicable securities laws remains with the company. Information in this presentation reflects securities laws and other relevant standards that are in effect as of the date of the presentation. The contents of this presentation should not be modified without the express written permission of the presenters. So we have a number of topics to cover today as outlined in this chart. We have reserved some time for questions at the end of the presentation. You can submit questions at any time using the chat function in the webinar. However, please note that we'll be responding to all questions at the end of the presentation. The objective of the OSC SME, or Small and Medium Enterprises Institute, is to support SMEs in facilitating cost-effective compliance through issuer outreach and education. It's important for issuers to know the requirements and to help them navigate regulatory waters. The idea is that if we can help issuers to better understand the disclosure requirements, they can focus their limited resources on building their company. Ultimately, we both have the same goal, for issuers to provide appropriate and meaningful information for investors. It is important to remember that at the end of the day, investor confidence in the information that companies provide is critical to the success of the company. So our Continuous Disclosure Review program is critical to investor protection as it monitors issuer compliance with the Continuous Disclosure Rule requirements. Continuous disclosure documents are important as they provide information to investors for making investment decisions. We help companies understand and comply with their continuous disclosure obligations through our compliance programs and issuer outreach and education initiatives. We complete two types of continuous disclosure reviews. One, full reviews which are broad in scope and generally involve a detailed review of an issuer's continuous disclosure record for at least the past 12 months. And two, issue-oriented reviews, or IORs for short, that focus on specific accounting, legal, or regulatory issues that we believe warrant scrutiny. We generally select issuers for review using a risk-based approach. Additionally, we may select an issuer for review if a filing appears to be substantially non-compliant with a requirement of the Securities Act or regulations, a filing appears to contain information that is misleading, false, deceptive, or a misrepresentation, we are seeking to assess compliance with new regulatory or accounting requirements, or the issuer is impacted by an emerging risk or market trend. We typically correspond with issuers through comment letters. The potential outcomes of our review include issuer outreach and education, prospective disclosure enhancements in future filings, refilings or other regulatory actions for significant deficiencies. Specifically, an issuer may be added to the OSC's 3-year refilings and errors list, which is accessible on our website. This could happen if staff identify a deficiency in a continuous disclosure document which requires refiling. You can also refer to our staff notice on this matter, which is OSC Staff Notice 51-711. In situations where significant deficiencies have been identified, we may also refer the issuer to our enforcement branch, or consider a cease trade order, or note the issuer in default on the OSC's reporting issuer list, which is also accessible on our website. This could happen in many different circumstances. One example is when an issuer is in default of a specific requirement, such as when it has not filed a continuous disclosure document by its due date. As you may already know, the CSA established a harmonized program for continuous disclosure reviews in 2004. The goal of the program is to improve the completeness, quality, and timeliness of continuous disclosure by reporting issuers in Canada, and to ensure that Canadian investors receive high-quality disclosure from these issuers. For further details on the Continuous Disclosure Review Program, we refer you to CSA Staff Notice 51-312. That notice talks about the objectives of the program, how we select issuers for review, which, as I mentioned, is generally a risk-based approach, a description of the types of reviews we conduct, the review process, and how we resolve issues. What I want to focus on now is CSA Staff Notice 51-346, which summarizes the results of our Continuous Disclosure Review Program activities for our most recent year ended March 31st, 2016. This notice was issued jointly across the CSA. It outlines broad results of 902 continuous disclosure reviews, of which 31% were full reviews and 69% were issue-oriented reviews. This chart depicts the outcomes of those reviews across the country. We classified the outcomes of all reviews into 5 categories. Some reviews generated more than one category of outcome. For example, an issuer may have been required to refile certain documents and also make certain changes on a prospective basis. The largest review outcome was in the prospective changes category. In 31% of cases, our review resulted in a commitment from an issuer to amend disclosure on a go-forward basis as a result of our review. When more material deficiencies or errors are identified, we generally expect issuers to correct them by restating and refiling the related documents. This occurred in 23% of cases last year. Overall, you will see that 62% of our review outcomes required issuers to take action to improve and/or amend their disclosure, or resulted in the issuer being referred to enforcement, cease traded, or noted in defaults, and this is compared to 59% in fiscal 2015. So as I mentioned, our review results relate to both full and issue-oriented reviews. This slide focuses on the issue-oriented reviews we completed over the past year. In fiscal 2016, 69% of all continuous disclosure reviews were issue-oriented reviews. The pie chart on the slide breaks down the past year's IORs by topic. This list changes from year to year as we may undertake an IOR for various subject matters or issues that are emerging at a given time. The largest number of reviews were performed around mining and oil and gas technical disclosures and gender diversity. The other category shown in the pie chart includes reviews performed for corporate governance, management information circulars, and material contracts, among others. I'm going to elaborate now on key findings from some of the fiscal 2016 issue-oriented reviews I just mentioned. For many of the issue-oriented reviews we perform, we will go on to publish a staff notice outlining our findings. You can refer to those notices for additional detail, but in brief, Staff Notice 58-307 outlines findings on our issue-oriented review of compliance with the gender diversity disclosure requirements under National Instrument 58-101. We will provide an update on this initiative specifically later in our presentation. Staff Notice 51-726 outlines findings on our review of insider reporting. Through our reviews, we continued to find deficiency in insider reports filed by insiders of reporting issuers of all sizes. We encourage issuers to engage with their reporting insiders more frequently to ensure the accurate and complete reporting of all insider information. As a final point in our discussion of CSA Staff Notice 51-346 and our fiscal 2016 Continuous Disclosure Program results, I also want to mention that 51-346 contains an appendix which has a list of common disclosure deficiencies that we more often observe in our reviews. This list gives both our observation as well as considerations for improving disclosure. The common disclosure deficiencies included in the 51-346 appendix, should you wish to refer to it, include financial statement deficiency observations, including items such as business combinations, functional currency, and operating segments, Mdna deficiency observations, including observations on liquidity and capital resources, forward-looking information, and the use of non-GAAP measures, observations of deficiencies on other topics such as material contracts, audit committees, information circulars, and annual information forms are also discussed in this appendix. Some of these deficiencies, particularly the Mdna deficiency topics, will be discussed later in this presentation. As a separate topic, I will also mention very quickly OSC Staff Notice 51-727. This is the annual report published by the OSC Corporate Finance Branch on our fiscal 2016 activities. The report provides a broad overview of our branch's activities, including consolidated comments on many of the topics that we will otherwise discuss in today's session, such as MD&A trends and guidance and non-GAAP measures. The report also provides the statistics on this slide, which are the outcomes from our full and IOR reviews over the past year. This is very similar to the outcomes we discussed a few slides ago, except this slide, like our branch report, is limited to Ontario only, whereas the previous discussion was on continuous disclosure program activities across the CSA. Further details on the outcomes of each of these reviews can be found in our branch report. That report, as well as the individual staff notices referenced earlier on each of these reviews, are useful resources to consult to the extent that each applies to you. Our next topic is best practices for working through a comment letter from corporate finance staff. When staff perform one of the full or issue-oriented continuous disclosure reviews that we've discussed, we raise and resolve issues by writing comment letters to management. We wanted to include in today's material some thoughts on how companies can manage the comment letter process to make that process as efficient and effective as possible. We view these as important because while there may be a perception that writing a brief response could save time at the outset, our view is that extra time put into a more detailed response up front will save time in the long run by reducing the amount of back and forth and the volume of subsequent comment letters needed to ultimately conclude the process. So again, on the assumption that you have just received a first comment letter from staff in connection with the new continuous disclosure review, on first glance, the opening paragraph should give you an idea of what kind of review we're performing, a full review or an issue-oriented review on a specific topic. The closing paragraphs will also contain a response timeline. It's important that you take note of the response timeline and plan for it early on. Second, our comment letters are typically addressed to and received by a company's CFO, but it remains the company's responsibility to respond. Once received, the company needs to decide who to involve in the response process, both internally and externally. It's usually intuitive to determine who to involve internally, depending on the subject matter of the letter. In terms of who to involve externally, there is no obligation to involve your legal counsel, but depending on the complexity of the review topics, it may be a good idea to do so. The more complex the review issues, the more the need to do accounting research or to cite legal precedents, the more advisable it may be to involve external experts such as legal counsel and auditors. It generally helps to involve them early on. Late involvement may make it harder for you to comply with the response timeline specified in the letter. The third point I'd like to make is about seeking clarification. Each comment letter will include our contact information, and it never hurts to use it to initiate a discussion if you're not clear on a question being asked in a letter. One cautionary point, though, if you do call us to ask clarifying questions, please note that we cannot provide legal or accounting advice. That means broadly that we can't recommend any particular response or course of action. For example, if we identify an inconsistency in a document, we may not be able to provide you with advice on the best way to resolve that conflict. That remains, of course, a management decision, and our role is generally either to object or not object to a proposed resolution. The fourth point is the most important point and is about providing a fulsome response. So please ensure that you answer each question and address each aspect within a question. Consider avoiding global statements intended or assumed to address multiple questions. It's better to author a detailed response that clearly provides your view on each of the comments in the letter. More as opposed to less detail is recommended. Also, it is recommended to provide references to IFRS or securities law in support of your positions when necessary for a technical issue. This generally helps to solidify your conclusion. The fifth point is about your ongoing filing obligations during a review. The key point here is that those obligations don't change. Financial statements must continue to be filed by their filing deadlines, regardless of whether they may be impacted by issues subject to ongoing comment letters and review, and the same is true for your other continuous disclosure documents. I would also note that staff review in no way detracts from management's responsibility for their continuous disclosure record. Responsibility always remains with management to ensure that its documents are complete and correct. As a final best practice point, it helps to be aware of review outcomes. I think we've already discussed the prospective outcomes and refiling outcomes, so I won't expand on them any further here. I will add that one of the positive aspects of a refiling is that it typically cures a breach of securities law. However, a corporate finance outcome such as a refiling does not preclude corporate finance from referring a file to enforcement even after a refiling has occurred. This could occur, for example, in more egregious cases, such as an issuer with repeated instances of defaults and refilings. In any case, regardless of the corporate finance outcome, a concluded review does not preclude the Commission from taking other action, such as referring instances of noncompliance to our enforcement branch or to initiating a further review in the future. That concludes this topic. I'm going to pass the presentation to Maria now, who will discuss certain MDNA topics.
Thanks, Tamara. Now we'll go through an overview of the MDNA and talk about some of the areas where we commonly see room for improvement. The MDNA is a narrative explanation through the eyes of management of what has happened during the period. It provides insights in analyzing information so as to add value for the reader. The MDNA should complement and supplement information provided in the financial statements rather than simply repeating information from the financial statements. The MDNA should also provide balanced reporting by addressing the bad news as well as the good, and should include new events that occurred during the period. In terms of general considerations, the MDNA should focus on material information and discuss important trends in the financial statements, explaining why balances have changed from period to period. Information may be considered material if it would affect the decision of a reasonable investor to buy, sell, or hold securities of the company. The balances presented in the MDNA should reconcile to the financial statements. This slide shows all of the components of the annual MDNA and is not meant to be intimidating, but rather encourage issuers to focus on the items that are material to their business. We continue to notice issues with a number of areas in the MDNA. Today, however, I am going to focus on two hot topics, liquidity and non-GAAP financial measures. So moving on to liquidity. Section 1.6 of Form 51-102 F1 outlines the specific requirements for the discussion of liquidity. The above slide highlights a few of the current hot buttons of this section. This section of the MDNA requires discussion of an issuer's ability to generate sufficient financial resources in the short term and the long term to maintain its capacity, to meet its planned growth, or to fund development activities. An issuer should avoid boilerplate language and ensure that the discussion is tailored and unique to the issuer's circumstance. If an issuer has or expects to have a working capital deficiency, the MDNA must discuss the issuer's ability to meet obligations as they become due and how the issuer expects to remedy the deficiency. Issuers must discuss any defaults or arrears or any significant risk of defaults or arrears on debt covenants. If an issuer is close to breaching its covenants, waiting to disclose this risk until after a covenant has been breached is not acceptable or useful and may have a material impact on investors. We encourage issuers with debt covenants to include the terms and conditions of the debt covenants, especially when a breach of the covenant could trigger a material additional funding requirement or early repayment. These disclosures are important to enable investors to assess how an issuer will meet its obligations and short and long-term objectives, particularly if an issuer's financial condition has deteriorated. So we'll go through a couple of examples to demonstrate these points. This is an example of boilerplate disclosure of liquidity and capital resources. So it states that at year-end, the company had cash of $10,000, total current assets of $500,000, and total current liabilities of $700,000. This resulted in a working capital deficiency of $200,000. Nonetheless, management is confident that the company has adequate financial resources to address its requirements and can arrange alternative sources of financing if necessary. In this example, the company repeats the balances for cash, current assets, and current liabilities, which are readily available from the financial statements, but does not provide an analysis of what these balances mean in relation to the liquidity and capital resources of the company. The company also states that it has a working capital deficiency of $200,000, but doesn't explain how it plans to address this deficiency. This next example is an example of entity-specific disclosure for the same company. So in this case, you'll see that the company provides a more thorough analysis of its liquidity and capital resources by discussing its ability to generate cash, specifically that it is early stage and therefore has no sources of revenue. The company also highlights that it has a working capital deficiency, but it indicates how it plans to meet its working capital obligations by borrowing from shareholders. And turning to the next slide, you'll see that the company also goes on to disclose its current cash burn rate of $100,000 per month and its capital expenditure requirements over the next 12 months. Overall, this disclosure has provided a more meaningful and useful analysis of the company's liquidity and capital resources. Now, this is an example of boilerplate disclosure of a company's covenants and related discussion. In this example, the company merely states that there are covenants attached to the loan facility. This example, however, provides entity-specific disclosure for the same company. In this case, the company specifically provides the covenant, its actual ratio versus the covenant, and provides a discussion on how the company intends to address this significant risk of default by using the proceeds of a disposition to reduce its debt. So moving on to non-GAAP financial measures, I'll discuss this in a bit more detail as it's recently been a hot topic in the press, both in Canada and internationally. There are actually 2 staff notices that have been published on this topic, which contain a lot of detail, including examples of what type of disclosure we expect. CSA Staff Notice 52306, which sets out our expectations in this area. And in December 2013, Ontario staff published a staff notice on our review of these measures, which is OSC Staff Notice 52722. Both of these are available on the OSC website. So what is a non-GAAP financial measure? It is defined as a numerical measure of an issuer's historical or future financial performance, financial position, or cash flow that doesn't meet the criteria of the issuer's GAAP for presentation in the issuer's financial statements, but is derived from a numerical measure in the financial statements. Essentially, non-GAAP financial measures are not based on GAAP, so they either exclude amounts that are included in or include amounts that are excluded from the most directly comparable GAAP measure. Companies often report some form of non-GAAP financial measures in addition to financial statement information in order to better analyze their results and report performance based on key measures that they believe provide useful information. Some common non-GAAP financial measures include EBITDA, which is net income excluding interest, taxes, depreciation, and amortization, free cash flow, adjusted earnings per share, and cash cost per ounce. If you disclose a non-GAAP financial measure in your MD&A, press release, or other continuous disclosure documents, staff expects that they are accompanied by the appropriate disclosures as outlined in detail in Staff Notice 52306. I will now go through each of the expectations and provide some examples of each, and also discuss some of the common deficiencies that we've seen. So the first expectation is to state explicitly that the non-GAAP financial measure does not have any standardized meaning under the issuer's GAAP and therefore may not be comparable to similar measures presented by other issuers. This slide shows how 3 different companies, all current reporting issuers, calculate adjusted EBITDA and demonstrates that this is generally not a comparable measure across companies or industries. You'll see that many of the items included or excluded from adjusted EBITDA are not consistent between companies 1, 2, or 3. So the second expectation is to name the non-GAAP financial measure in a way that distinguishes it from disclosure items specified, defined, or determined under an issuer's GAAP, and in a way that is not misleading. For example, in presenting EBITDA as a non-GAAP financial measure, it would be misleading to exclude amounts for items other than interest, taxes, depreciation, and amortization. As you can see in the example on this slide, severance, expected return on pension plan assets, and other expenses are deducted from the calculation of EBITDA. The third expectation is to explain why the non-GAAP financial measure provides useful information to investors, and the additional purposes, if any, for which management uses the non-GAAP financial measure. It is critical that companies explain the composition of the measure and its relevance so that investors and analysts are fully informed. The use of many different non-GAAP financial measures may not be useful or informative. The measures being disclosed should be carefully chosen to ensure only meaningful and useful information is provided. Furthermore, companies should explain why the various adjustments are consistent with the measure's intended purposes. When presenting various measures, such as the variety pictured in the slide, companies should explain the basis of each computation, how the adjusted measure differs from its most comparable GAAP measure, and why each measure is useful in different ways. The above slide shows some of the non-GAAP financial measures used in the Canadian marketplace today, and it gives you an idea of why it's so important to identify the measures that are meaningful to your business or industry. The fourth expectation is to present with equal or greater prominence to that of the non-GAAP financial measure the most directly comparable measure specified, defined, or determined under the issuer's GAAP presented in its financial statements. Prominence refers to both the order and manner of its presentation, as well as the emphasis of the related discussion versus the comparable GAAP measure. In the table above, we see an example where the most comparable GAAP measure is not presented with equal or greater prominence to that of the non-GAAP measure. In this case, adjusted EBITDA and EBITDA, being the non-GAAP measures, are presented before the most comparable GAAP measure, which is net income. Furthermore, by bolding the non-GAAP measures, more importance is placed on the non-GAAP measure, and a reader's eye is drawn to the bolded figure. Some other examples of more prominent non-GAAP measures could include omitting comparable GAAP measures from an earnings release headline or title that includes non-GAAP measures, referring to non-GAAP measure as highest ever or record high without an equally prominent description of the comparable GAAP measure, discussing positive results in non-GAAP financial measures without a balanced discussion of any negative results in its GAAP measures, or focusing on the MD&A analysis on non-GAAP with less emphasis on GAAP analysis of results. Companies should also consider the prominence they give to non-GAAP financial measures in their earnings calls and other presentations, and ensure that the GAAP measures are given equal or more prominence to the non-GAAP financial measures. The fifth expectation is to provide a clear quantitative reconciliation from the non-GAAP financial measure to the most directly comparable measure specified, defined, or determined under the issuer's GAAP and presented in its financial statements, referencing to the reconciliation when the non-GAAP financial measure first appears in the document, or in the case of content on a website, in a manner that meets this objective, for example, by providing a link to the reconciliation. If you are providing a link to the reconciliation, make sure that the reconciliation is timely. It should not link to a previous period's reconciliation, but rather the figure linked should directly tie to the reconciliation provided. The sixth expectation is to ensure that the non-GAAP financial measure does not describe adjustments as non-recurring, infrequent, or unusual when a similar loss or gain is reasonably likely to occur within the next 2 years or has occurred during the prior 2 years. Many companies exclude non-recurring items to demonstrate what a normalized figure would look like, and so excluding or including a recurring gain or loss would not provide a normalized figure and would be potentially misleading. The seventh expectation is to present the non-GAAP financial measure on a consistent basis from period to period. And where there are changes to the composition of the non-GAAP financial measure, you would need to explain the reason for the change and also restate any comparative period presented. So some of the common deficiencies that we see are where non-GAAP financial measures are presented with greater prominence than GAAP measures. We also see companies spotlighting the good and playing down the bad. For example, by disclosing positive working capital by including adjustments when there is actually a working capital deficit. We also see companies using multiple different non-GAAP financial measures without providing an explanation of why they are useful. Focusing the discussion on these measures could convolute the MD&A, making it very confusing and difficult to understand. So we'll go through an example to demonstrate a couple of these points. On this slide, we have an example of what could be considered placing prominence on the non-GAAP financial measure, adjusted EBITDA. You'll note that only adjusted EBITDA is discussed, As well, the discussion highlights the very positive picture of performance that Adjusted EBITDA paints over the year by stating that Adjusted EBITDA totaled $65 million in 2015, an increase of 12% from $59 million in 2014. Conversely, in this example, you'll see that the company mentions and discusses net income first and foremost, stating that net income for the year decreased by 32% to $44 million. Only after this discussion does the company discuss the Adjusted EBITDA figure, as in the first example. You'll also note that net income decreased by 32% over the year, whereas Adjusted EBITDA increased by 12% over the year. This shows a scenario in which a company could be inclined to show the non-GAAP financial measure more prominently to that of the GAAP measure. Next is an example of an insufficient explanation of what makes the non-GAAP measure useful to management and investors. In this example, Adjusted EBITDA is described as the most useful measure because it provides normalized earnings. This description does not explain how and why management uses the measure in order to make strategic decisions or to assess performance, nor does it explain why the measure would be useful to investors. In this example, though, the company clearly indicates that Adjusted EBITDA is an important indicator of the company's ability to generate liquidity through operating cash flow to fund future working capital needs, service outstanding debt, and fund future capital expenditures, and use the metric for this purpose. It's clear from this disclosure how and why management uses this measure. The company also states that Adjusted EBITDA is also used by investors and analysts for the purpose of valuing a company. The non-GAAP financial measure guidance set out in CSA Staff Notice 52306 are applicable to all continuous disclosure documents, as well as website materials, investor presentations, and press releases. It is also important to note that if you use non-GAAP financial measures as forward-looking information, or FLI, the guidance under CSA Staff Notice 52306 would apply, as well as the FLI requirements which are set out in NI 51102, Part 4A and 5.8, as well as the expectations in OSC Staff Notice 51721. The SEC published helpful compliance and disclosure interpretations, or CDIs, on the use of non-GAAP financial measures in May 2016. The CDIs include updated guidance and provide clarifying examples in areas of frequent staff comments, including misleading non-GAAP presentations and non-GAAP measures with greater prominence than the comparable GAAP measures. While the SEC requirements may not be identical, staff find that this SEC publication may be helpful to issuers. And as mentioned earlier, please refer to OSC Staff Notice 52722, Report on Staff's Review of Non-GAAP Financial Measures, as it provides insights into common deficiencies and things we've noted in the past. So now I'll hand it over to Jonathan.
Okay, thanks, Maria. So our next topic for the session today is National Policy 51201. And this is a session where we're going to talk about the broad expectations that we have in regards to the disclosures that reporting issuers provide and some of the standards that those disclosures should live up to. This is, in a lot of ways, going to be a very qualitative discussion about the attributes of positive disclosure practices. And it's an important discussion because both positive and negative disclosure practices can be observed in any type of communication that issuers provide on a day-to-day basis. So from discussion in MD&A to wording in a press release or on a corporate website, during an investor presentation or in commentary on social media, there are many different types of disclosures and disclosure venues as well to which these same disclosure expectations apply. So because of that, this is a topic that we're seeing increasingly and raising in comment letters with increased frequency. So this first slide summarizes some of the core disclosure concepts that are outlined in National Policy 51201. For example, it talks about the risk of selective disclosure and things that need to be done to prevent different market participants from being provided access to material non-public information at different times. It also talks about the need for disclosure to be balanced such that it doesn't exaggerate or mislead. And it talks about the need to disclose certain information immediately when it rises to a certain level of materiality. And in this case, I'm speaking about information that constitutes a material change. Each of these are areas that are discussed in more detail over the coming slides, and the first one that we'll talk about is timely disclosure. So broadly speaking, and for background, when an issuer files a prospectus, it includes full, true, and plain disclosure about any material information about the company in that document. After a prospectus, and as time goes on, issuers provide continuous disclosure in the form of quarterly and annual financial statements, MD&A, as well as potentially AIFs, information circulars, or other documents. These continuous disclosure documents update your disclosure record as time passes, but they don't necessarily result in all material information being disclosed in real time as material events occur. So for that reason, if an event or transaction occurs that meets the definition of a material change, then the timely disclosure obligations are triggered, which require reporting in advance of and incremental to continuous disclosure reporting timelines, and that would be a material change. So material change includes a change in the business, operations, or capital of an issuer, which would be reasonably expected to have a significant impact on the market price of securities of the issuer. There are any number of examples of what could constitute a material change, but just as a few examples, certainly not exhaustive, a material change could relate to a significant acquisition, a financing arrangement, an important new contract, a change in CEO or CFO, or a change in the issuer's line of business. And while I'll come back in a minute to the determination of what's considered to be material, the main point here that I want to emphasize is that when a material change occurs, companies have a few obligations. First, they need to issue a press release immediately identifying the material change, and within 10 days a material change report needs to be issued as well. For material changes that the company initiates, a material change occurs once the decision has been made to implement it. And that could happen even before a company's directors approve the decision, if a company thinks that it's probable that they will do so. So the disclosure expectations discussed in National Policy 51-201 extend to more than just material changes. They actually relate to any material information. And material information includes both material changes, which we just spoke about, as well as material facts, which are defined on this slide as something that could reasonably be expected to affect the value of your stock. While material changes trigger the immediate disclosure obligations under securities law that we just spoke about, material facts may not. In either case, though, what we want to ensure is that when material non-public information is disclosed, it is generally disclosed to the marketplace such that certain individuals don't get early access to that information. And this goes to the selective disclosure concerns that are outlined on this slide. As we talk about the risk of selective disclosure, a key question becomes, in order to avoid selective disclosure, how do I make sure that material non-public information is generally disclosed before I provide that same information to selected individuals, and which would otherwise be a selective disclosure risk? National Policy 51-201 provides examples of what would constitute general disclosure, or meet the generally disclosed criteria in this regard. Really, we would look to make sure that information was disseminated in a manner that would effectively reach the marketplace, and we would look to see that public investors were given a reasonable amount of time to analyze that information in order for it to be considered to have been generally disclosed. Just as an example of when companies may struggle with ensuring that material information has been generally disclosed, we could take, for example, a company that posts a material fact on a social media website, and unlike a material change, there may not have been a timely disclosure obligation in respect of the material fact, but since the company has chosen to disclose that information on a social media website, OSC staff may challenge how the company has determined that the disclosure on social media alone, as opposed to disclosure on CDAR and in a press release as well, satisfied the generally disclosed requirement for material information. If the material information was released without being generally disclosed, then we would have potentially selective disclosure concerns. Before we move on from talking about selective disclosure, I would point out one exception to this requirement, that material information be generally disclosed when it's released. And specifically, under securities legislation, that is that material non-public information may be disclosed in the necessary course of business, such as in a contract negotiation with a supplier, without first being generally disclosed. So the next aspect of our disclosure standards that I want to talk about is balanced disclosure, and this is an important point because unbalanced disclosure, or disclosure that is promotional in nature, can mislead investors and cause stock price volatility that's not fully informed. For that reason, National Policy 51201 outlines our expectations that disclosure be factual and balanced. To achieve that, disclosure needs to be sufficiently clear so that investors can understand the importance and the substance of the issue being disclosed. And understanding the substance of an issue means understanding both its positive and its negative aspects. So issuers need to keep in mind that if they announce a positive development, like a decision to enter a new industry, for example, then they cannot withhold or give less prominent disclosure to unfavorable aspects of that decision, such as risks and uncertainties involved in executing that plan. These are themes that we talked about more extensively back in 2015 when the Canadian Securities Administrators released CSA Staff Notice 51-342, which was a notice that talks about the disclosure provided by some issuers as they, at that time, contemplated entry into what was then a very new medical marijuana industry sector in Canada. As in particular, that notice indicated that companies announcing their intent to enter the marijuana industry back at that time often saw strong stock price appreciation when they announced a decision to enter the industry. But that announcement, which was perceived in a positive light, was not always accompanied by a discussion of the potential negative risks, uncertainties, costs, contingencies, or barriers to entering the medical marijuana industry at that time. So those costs, contingencies, or barriers may have included things like the fact that these companies, some of them did not have a license to sell marijuana, had not started to build the infrastructure required in order to support such a license application, and would require significant time and costs in order to achieve those goals because these were companies that hadn't yet executed that transition but were announcing an intent to do so. As a result of the absence of disclosure giving equal prominence to these unfavorable aspects of the decision these companies made to enter the new industry, CSA Staff Notice 51-342 took the position that certain disclosure was promotional and unbalanced. As a result, many of the companies we reviewed in that notice, in the process of preparing it, issued clarifying press releases in connection with an OSC review, and they were added to our refilings and errors list at that time. So I only mentioned this notice on marijuana companies, which is from a few years ago, because it underscores the importance of balanced disclosures for companies in any industry announcing any news item. And that's why the discussion of Staff Notice 51-342 is especially useful here, because it has applicability beyond marijuana companies. While the notice talks directly to companies that are exploring the marijuana industry, the theme of the notice is balanced disclosure. And as a result, the notice is a useful resource for companies operating in any industry and providing any disclosure, because it's a reminder of the balanced disclosure obligations that exist in general, and that goes beyond any industry, certainly. So separately, I would point out that OSC Staff Notice 51-727, which is our 2015-2016 Corporate Finance Branch Activities Annual Report, contains a discussion of the importance of balanced disclosure in all contexts. And this is really to encourage issues to be mindful that our concerns around unbalanced disclosure are not limited to traditional continuous disclosure filings like financial statements and MD&A. Rather, we often have concerns with unbalanced disclosure in other disclosure formats like in press releases, investor presentations, on company websites, or on social media. For example, we've seen instances where issuers have provided forward-looking information like a positive forward-looking revenue target for the coming year on a social media website, And to the extent that that forward-looking target would represent strong growth for a company, to the extent that the company does not discuss assumptions or risks and contingencies that may be involved in meeting that target, and to the extent that the target is selectively disclosed because it's only posted on social media and not otherwise disseminated, then we could view that as selective or unbalanced disclosure. Again, OSC Staff Notice 51-727 summarizes some of our concerns here by emphasizing that issuers should consider all of these disclosure standards in all of their communications, even and sometimes especially outside of their core continuous disclosure documents. So this next slide provides a further example of unbalanced disclosure. The example here indicates that on October 3rd, the company signed a letter of understanding with a major retail company listed on the London Stock Exchange for an agreement that had a 10-year term and is anticipated to result in $1 billion of sales to the company and its products over that term. So after reading this sample disclosure, we're certainly left with the impression that the positive aspects of the announced initiative have been provided. The question becomes, is an announcement explaining the positive implications of this development promotional or unbalanced, to the extent that it doesn't discuss other risks, uncertainties, contingencies, costs, or barriers to realizing the $1 billion in revenues over the next 10 years that's implied by this disclosure? And we would suggest that yes, depending on what contingencies do exist here, the initial disclosure presented could be misleading. On this slide, the disclosure has been revised to address those issues. Here the company has deleted words like major when describing the customer as a major retail company, since that type of language is generally promotional because it may not be objectively supportable. They've also specified now that the revenue arrangement is a non-binding arrangement reflective of a potential customer's intent to purchase as opposed to a customer's contractual commitment to purchase. They've provided other background about the relationship, such as detail explaining that the product to be sold under this arrangement is still being customized for the potential customer, and that if this can't be done to the potential customer's satisfaction, then there may be no sales at all. And they've also given more detail about how the $1 billion potential revenue figure was derived and some practical reasons why the company can't control it or assure that it will be met, or that the customer themselves has the ability to meet it. So in this way, the revised disclosure on this slide is significantly more balanced because it addresses cost contingencies and barriers to achieving the items being announced. Certainly in this example, the balancing disclosure, which was missing from the original unbalanced or potentially unbalanced narrative, is significant. And this is an example that does make it clear how an investor could be misled by unbalanced disclosure. Now, overall, the disclosure expectations that are outlined in National Policy 51-201 are predicated on information being material. And as a reminder here, material information includes both material changes and material facts, as previously discussed. The policy, National Policy 51-201, includes guidance with a number of examples on the type of events that may be material, which I refer you to. The examples in the policy are grouped into different types of events that are shown on this slide. But these examples are certainly, of course, not intended to be exhaustive. Rather, they're a starting point for issuers to themselves consider what type of information could reasonably be expected to have an impact on the price of its securities, which may be material. Our overall message here is that, as you would expect, significant judgment is involved in determining what is material. As regulators, a significant stock price reaction to an announced event gives us a good indication that the disclosure involved could have been material, which may present a basis for us to challenge a different materiality assessment that could have been made by management. If an issuer discloses information in a way that's not timely, not balanced, or which constitutes selective disclosure, and if in the process of one of our reviews that disclosure was minimized in the sense that it was viewed as not a deficiency because the information was not material, then issuers should consider the risk that they would be in breach of our disclosure requirements, especially to the extent that their materiality assessment was successfully challenged by staff. As a final note on our disclosure standards, I would point out that National Policy 51-201 contains additional guidance about best disclosure practices. This includes a discussion of measures that may help minimize the risk of noncompliance with securities laws, including establishing a corporate disclosure policy, elements of that policy, best practices for board and audit committee review of certain disclosure, and insider trading policies and trading blackout periods. National Policy 51201 also contains further background and discussion on all of the disclosure topics that I've touched on over the last couple of slides for your reference. So the next topic that we'll move to is Form 51102 F2, and this is the form that prescribes the form and content of an annual information form. So I'm sure that we're all familiar with the annual information form generally, and for that reason our objective today is not to go through its contents and requirements in totality, but merely to point out a few aspects of the form where we more commonly observe disclosure deficiencies in the course of our reviews. And generally, the observations that we want to talk about here relate primarily to risk factor disclosure provided in an AIF, or in the case of venture issuers who do not prepare an AIF, the risk factor disclosure concepts that we'll talk about would relate to the risk factor disclosure that you would provide in your MD&A. So for that reason, the discussion in these slides should be applicable to all companies regardless of whether you prepare an AIF or not. So first, just as a general reminder on the nature and purpose of the annual information form. So this is a document that's required for any issuer who doesn't meet the definition of a venture issuer. We note, though, that some venture issuers do elect to prepare an AIF, and one of the reasons a venture issuer may elect to prepare an AIF may be so that they can qualify for a short form prospectus as opposed to a long form in the event that they wish to raise public equity during the year. The AIF is intended to provide material information about your company at a point in time, which is generally as at the last day of your most recently completed financial year. This disclosure is supplemented through the year by your continuous disclosure filings. And in terms of the common disclosure deficiencies which I mentioned that I'd like to cover in relation to the AIF, the first two items in the chart on this slide are drawing attention to our expectation that AIF disclosure should include a robust and detailed description of the issuer's business, including a discussion of segment operations along the lines of operating segments that are identified in your financial statements prepared in accordance with GAAP. And it should also include a discussion of important aspects of the business not limited to competitive conditions, new contracts, economic dependence, and other conditions listed on this slide and in Form 51102 F2. The other commonly observed disclosure deficiencies noted on the slide involve risk factor disclosure, and the AIF requires disclosure of risks which may impact your business broadly. This is important disclosure that helps investors understand the risks of securities they may consider purchasing, and that risk disclosure should be listed for that reason in order of seriousness, with more important risks listed first. The risks should be sufficiently detailed, and they should contain enough information in order to understand how the risk applies to your company rather than being general in nature. That should include qualitative and quantitative information to help investors understand how the risk may impact your company. The risk factor disclosure should not include de-emphasizing language that implies the risk will not materialize. And lastly, if certain risks have become more important during the period, for example, risks related to liquidity and cash flows when a company is experiencing going concern issues, then those risks should be updated in the current period in order to reflect changes that have happened during the year. So let's continue talking about these disclosure expectations by looking at an example of risk factor disclosure. On this slide, we have an example of what could be considered as boilerplate AIF risk factor disclosure in relation to economic dependence on a significant customer. So the disclosure here indicates that 60% of this company's revenues are generated by a subsidiary called Downstream Corporation, which was acquired in March of the current year. 50% of the subsidiary's revenues are derived from a single customer. And it also indicates in this sample disclosure that the business would be materially adversely impacted if that customer went to another competitor, And as a result of the company's strong relationship with the customer, it indicates that the risk of losing the customer is assessed to be remote. So on this next slide, the risk factor disclosure has been revised to include some additional information which is more entity specific. While the original risk factor on the last slide disclosed the existence of economic dependence on a major customer, it didn't provide additional entity-specific facts which may exist, which would help the reader understand why the risk was pronounced in this circumstance. So this slide discloses now that the major customer of Downstream Corporation was its former owner before Downstream Corporation, the subsidiary, was sold to the company. And it discusses the risk that the major customer may as a result have less of an incentive than they historically did to remain a customer of the company as a result. The revised example also adds discussion about how the company is attempting to mitigate this risk, in that it's attempting to negotiate a long-term contract to assure a continuity of revenues. But the disclosure is balanced here because it makes it clear that no such arrangement has been finalized and that there's no assurance that one will be finalized. Also, de-emphasizing language has been removed, and specifically I'm referring to the last paragraph here, where the company has removed wording around their strong relationship with the customer, which in their view makes the risk less prominent. Overall, you can see that the revised disclosure is much more entity specific because it provides relevant facts that help you to interpret the significance of the risk in light of the entity's specific circumstances. So our next topic is the information circular form, and similar to our last topic with the AIF, our intention here is not to walk through the entire information circular form, but only to touch on a few hot topics and specific areas where we more frequently see compliance issues in practice. So this slide summarizes 3 specific hot topics relating to the information circular form, and these are the 3 hot topics that I want to walk you through here. The first one is about situations when prospectus level disclosure is required in an information circular. And what's important to understand here is that when a circular is prepared so that shareholders can vote on a restructuring transaction or a share acquisition such as a reverse takeover or a merger, these are circumstances where shareholders are voting on a transaction that may result in a significant change in the ownership structure of the company, and it could mean that the post-transaction entity would look substantially different. So for example, in an RTO, the RTO target is often the main operating company, which is becoming public for the first time as a result of the RTO transaction. So as a result of that, item 14.2 of the information circular form, Form 51102F5, indicates that these are situations in which prospectus level disclosure is required in the information circular that's prepared in order for shareholders to vote on these types of transactions. And that's important because that means that you may need the disclosure that would normally be contained in a prospectus in your information circular, such as, for example, 3 years' worth of financial statements. Specifically, item 14.2 requires that each entity which is a party to a restructuring transaction must provide disclosure in their information circular that satisfies the form of prospectus which it would be eligible to file immediately prior to the information circular being filed. So in practice, that means that if a reporting issuer shell company is executing an RTO with a private operating company, the operating company is not eligible to file a short-form prospectus prior to the transaction since it's a private company. Therefore, long-form prospectus requirements would need to be satisfied, and the private company would potentially need to provide 3 years of audited financial statements in the circular. So those are all the points that I wanted to make on the first hot topic listed on this slide. The next 2 hot topics listed on this slide both relate to executive compensation disclosure in an information circular, and the next few slides will further elaborate on those 2 points. So the first point is about the compensation discussion and analysis disclosure that's contained in your executive compensation disclosure. The compensation discussion and analysis is a foundation for the executive compensation disclosure that's in your circular. It's important because it describes significant elements of compensation, how a company determines them, the objectives of the compensation program, as well as other attributes such as those summarized on this slide. A robust compensation discussion and analysis along these lines is needed in order to put into perspective the executive compensation disclosure that follows, including the quantitative information that's in the summary compensation table in respect to named executive officers. Often we see companies presenting a compensation discussion and analysis that's generic or that does not adequately discuss the strategic intent and the method of determining various elements of the compensation program, and we want to emphasize here the importance of tailoring and developing this important disclosure. As I mentioned on that last slide, an important component of the compensation discussion and analysis disclosure is a discussion of how the company determines its compensation levels for each element of compensation. Often the determination of compensation levels will involve benchmarking against other comparable companies, and when a company considers a benchmark group of companies in setting its own compensation, it needs to include a discussion of the benchmark group in its executive compensation disclosure. Specifically, you'll need to disclose which companies were included in the benchmark group and why they were included, which involves discussing how these benchmark companies were considered to be relevant and comparable to your company. And that could be because they were in a similar industry, because they operated in a similar region, had similar revenues or similar market capitalizations to your company, for example. In any case, the takeaway is to disclose the identity of the benchmark group and on what basis the benchmark group of companies was considered to be relevant to you. I will note, though, that if a company does not in any way use a benchmark group in determining its own compensation levels, then there would of course be no obligation to provide disclosure around a benchmark group, but that's a situation in which a company should provide a discussion of how else it's determined its compensation levels. The next slide has a brief example of what we would consider to be boilerplate benchmarking disclosure. I'll go through the example very quickly, but in this case you can see that what we would consider this disclosure to be boilerplate because it simply refers to the use of a benchmark group of companies without identifying the companies in the benchmark group and without saying on what specific basis those companies were selected as comparable. This next slide provides revised disclosure which addresses those issues by identifying the companies in the benchmark group and discussing the basis on which they were comparable to the issuer, in this case on the basis of revenue, market cap, and net income levels. One other aspect of the compensation discussion and analysis that I want to mention is the discussion of performance goals. Performance goals are important because when investors look at executive compensation disclosure, they should be able to understand the link between the objectives of your compensation program and the compensation that was actually paid out at the end of the year. To do that, companies should have disclosure that acknowledges the performance goals that you've set, which discusses whether and to what extent these goals were met, and which links the achievement of these goals to the decision to award various levels of compensation. The requirement here is to disclose information about the company's compensation program, so if a company only pays fixed compensation, then there may be no performance goals to be disclosed, but any variable compensation which is dependent on the achievement of milestones, agreements, share price objectives, or EPS objectives, amongst other performance targets, should be disclosed. On this slide, we have some sample disclosure about executive compensation performance goals. The example states that annual bonuses are determined 50% based on subjective personal performance and 50% based on the achievement of specific corporate measures such as net earnings and share price performance. This disclosure is generally boilerplate in nature because it doesn't quantify the net earnings and share price performance targets that have been used to determine compensation, and because it doesn't discuss the link between those targets and the compensation that was actually paid, including whether the performance targets were actually achieved. This slide revises that disclosure to address those issues. You can now see that the specific performance measures used have been quantified and disclosure has been added to comment on whether the objectives have been met. Okay, so that's all I wanted to mention in terms of compensation discussion and analysis and that portion of the executive compensation disclosures. The next hot topic that I want to address is related to executive compensation, and specifically about what compensation is required to be disclosed. The key point here is that in executive compensation disclosure, companies need to disclose all elements of compensation that's paid or payable to named executive officers and directors. And that applies to compensation that's paid directly by the company to a director or officer. But it also applies to indirect compensation. As an example of how this might apply, we've seen executive compensation disclosure that states that a company's CEO receives no compensation from the company. In these cases, we always look to determine whether the individual in question is being indirectly compensated in any way. A simple example would be if a company retains CEO services from an external management company. In that case, any amounts which the company pays the management company in respect of CEO services should be reported as CEO compensation, even if these fees represent indirect compensation because they're paid to a management company and not directly to the CEO. Additionally, if the amount the management company pays the executive is in consideration of many types of services, only one of which is to the issuer disclosing executive compensation, then the basis of determining how much of the total amount represents compensation for the issuer should be disclosed. Again, the key message here being that all forms of compensation, both direct and indirect, need to be disclosed in the executive compensation disclosure within your circular. So that ends this topic. I'm now going to pass the presentation to Ray, who's going to talk about cease trade orders.
Thanks, Jonathan. The next topic in our presentation today is cease trade orders. In the event of a failure to file certain documents like financial statements or MD&A, CSA regulators generally respond by issuing a failure to file cease trade order, also referred to as an Ff Cto. An Ff Cto orders that all trading in the securities of the reporting issuer shall cease until further ordered. We issue Ff Ctos because investors and prospective investors should be able to make an informed investment decision about the securities of the defaulting reporting issuer. There is also heightened potential for insider trading which may compromise the integrity and fairness, or confidence in the integrity and fairness, of the capital markets if trading in securities of the reporting issuer is permitted to continue. The practice of responding to a specified default with a failure to file cease trade order has a significant positive effect on general compliance. The prospect of a cease trade order creates a strong incentive for the reporting issuer's management to avoid a specified default. Similarly, the issuance of a cease trade order once the issuer is in default creates a strong incentive on the part of management to diligently rectify the specified default. All of the information provided on this slide is contained in National Policy 11207. The policy provides guidance to issuer as to how the Canadian securities regulators will generally respond to specified defaults. Generally, an FFCTO is issued after noting an issuer in default for a specified default. A specified default is defined as a failure by a reporting issuer to comply with the requirement to file within the prescribed time period annual financial statements, an interim financial report, annual or interim management's discussion and analysis, annual information form, or certifications of filings. These type of CTOs are also referred to as a failure to file CTO. Regulators typically respond to a specified default with a FFCTO, or if management applies for it, a management cease trade order, which will be discussed later in the presentation. An FFCTO orders that all trading in the securities of the reporting issuer shall cease until further ordered by the director. The issuance of an FFCTO or an MCTO does not hit the pause button on an issuer's CD obligations. Issuers must continue to satisfy other CD obligations, such as the requirements to file material change reports. It is important to note that in most jurisdictions, the definition of a trade includes acts in furtherance of a trade. In any particular case, it is a question of legal interpretation whether a step taken by an issuer is an act in furtherance of a trade, and therefore a breach of an FFCTO. Issuers should consult their legal counsel whenever there is any doubt. An issuer must obtain either a full or partial revocation before carrying out an act in furtherance of a trade. While we recognize that issuers may sometimes face difficulties in complying with filing deadlines due to circumstances beyond their control, we do not believe it is appropriate to vary a filing deadline simply to allow an issuer to avoid being in default. The CSA regulators will consider the issuer's circumstances in deciding what action, if any, is appropriate to respond to a default. Once an issuer is in default, a failure to file C-Trade order may be issued by the CSA regulator at any time. National Policy 12203, Management Cease Trade Orders, describes the voluntary process where specific insiders in management, rather than the issuer, are subject to a CTO. Insiders in management must cease trading in the securities of the issuer, while all other investors can continue trading. The director has discretion whether to grant an MCTO. Issuers satisfying the following criteria are eligible to apply. The outstanding filings must be filed within a reasonable period. Generally, this means within 2 months. The issuer must be generating revenue from its principal business or is actively pursuing the development of products or properties. The issuer has necessary financial and human resources in place to address the default and comply with other CD requirements for the duration of the default. The issuer's securities are listed on a Canadian stock exchange and there's an active liquid market for the securities, and the issuer is not on a defaulting reporting issuer list in any jurisdiction. Generally, CSA regulators expect an application to be submitted 2 weeks prior to the filing deadline. As I mentioned before, an MCTO does not hit pause on an issuer's CD obligations. 2 key communications in the MCTO process are the default announcement and the default status reports. If a reporting issuer determines that it will not comply or subsequently determines that it has not complied with the specified requirement, this will often represent a material change that the issuer should immediately communicate to the securities marketplace by way of a news release in a material change report in accordance with Part 7 of National Instrument 51-102. The CSA regulators will generally not exercise their discretion to issue an MCTO unless the issuer issues and files a default announcement containing the information set out in NP 12203. This information includes identifying the specified requirement in the default or anticipated default, disclosing the reasons for the non-compliance, disclosing the plans to remedy the issue, including the date it anticipates remedying the issue, and other material information. After the default announcement and during the period of the MCTO, the CSA regulators will generally not exercise their discretion to issue a management cease trade order or extend the cease trade order unless the defaulting reporting issuer issues biweekly default status reports in the form of news releases. The status report should update all of the information in the biweekly status report and confirm if there are any changes to the particulars noted in the default announcement. Please refer to NP 12203 for more details about the contents of the default announcement and the default status reports. So we've just talked about the issuance of FFCTOs and MCTOs. We're going to turn our attention now to the revocations of FFCTOs. Staff will generally revoke the FFCTO if within 90 days the default is remedied and the issuer's continuous disclosure is brought up to date, including any financial statements, MD&A, and certifications that subsequently become due following the issuance of the FFCTO. We will treat the filing of the late documents as the application to revoke the FFCTO, and a formal application is not required. Additionally, an application fee to revoke the FFCTO is not required. We will revoke the FFCTO on our own initiative, generally within a couple of days of the filing. If the issuer has outstanding fees owing, they will be required to pay those fees and any applicable late fees. So we just talked about the revocation process for FFCTOs in effect for less than 90 days. The process is different for FFCTOs that have been in effect for more than 90 days. FFCTOs that have been in effect for more than 90 days will require a formal application and application fee for the revocation of the FFCTO. The application fee in Ontario to revoke an FFCTO that has been in effect for more than 90 days is $4,800. The application fee also applies to most applications for partial revocations. All applications for a full revocation will result in some level of review of the issuer's continuous disclosure record for compliance. For revocations of FFCTOs that have been in effect for more than 90 days, this review may be similar to the full review under the Harmonized Continuous Disclosure Review Program. Generally, we will not exercise our discretion to grant a full revocation order unless the issuer has filed all of its outstanding continuous disclosure. There are certain exceptions where the director may not require certain documents to be filed. However, we generally consider that disclosure for periods within the most recent 3 years of a non-venture issuer provides useful information for investors, or the last 2 years for a venture issuer. Before we will issue a revocation order, the issuer must pay all outstanding fees to each relevant jurisdiction. Depending on how long the FFCTO has been in effect, the fees may be considerable, so the issuer should contact each CSA regulator before submitting an application to estimate the fees that will be payable. There may be fees for participation fees, filing fees, and late fees. An issuer applying for revocation should ensure that it has complied with the annual meeting requirement. If the issuer has not complied, we will generally not exercise our discretion to issue a revocation order unless the issuer provides an undertaking to hold an annual meeting within 3 months from the date the FFCTO is revoked. If the revocation is material change for the issuer is required to issue and file a news release and material change report. If the revocation is not a material change, the issuer should still consider issuing a news release announcing the revocation and describing the issuer's future plans. The last point I want to make on this slide is that notwithstanding that all continuous disclosure has been filed, Section 144 of the Securities Act requires that the revocation not be prejudicial to the public interest. So, for example, if there are ongoing enforcement investigations, staff may have additional comments or may not be able to recommend the revocation of the FFCTO. The previous slide described what happens during the review process. This slide outlines how and where to apply for a revocation for an FFCTO that has been in effect for more than 90 days. Issuers should follow National Policy 12202 or National Policy 11207 to revoke an FFCTO that has been in effect for more than 90 days. The national policy that applies is generally determined by the timing of when the FFCTO was issued. Issuers can confirm which process applies by reviewing the FFCTO. FFCTOs that include a reference to National Policy 11207, where the text in the order refers to NP 11207, will follow the process under NP 11207. All other CTOs will follow the process under National Policy 12202. Under National Policy 12202, an issuer should file an application with each jurisdiction that has issued an FFCTO. Under National Policy 11207, an issuer should file an application with Ontario if Ontario is the principal regulator. Alternatively, if the principal regulator is another jurisdiction and the issuer is a reporting issuer in Ontario, then the issuer should file an application with the principal regulator in Ontario. Applications to Ontario should be submitted through the OSC's electronic filing portal. So moving along to partial revocations of an FFCTO. An issuer can apply for a partial revocation of an FFCTO to permit certain transactions involving trades and securities of the issuer, such as private placements or share for debt transactions, to allow the issuer to recapitalize or to raise sufficient funds to prepare and file outstanding continuous disclosure documents. An application should be made to all jurisdictions where the proposed trades would occur. Regulators will generally not exercise discretion for a partial revocation unless the issuer intends to apply for a full revocation of the FFCTO. If the purpose of the partial revocation is to permit an issuer to carry out an exempt financing, the application should include an estimate of the amount the issuer expects to raise and an explanation of how the issuer plans to use the funds. The issuer should also include in the application the total amount that it will need to apply for a full revocation, including the funds needed to prepare and file the documents required to bring the issuer's continuous disclosure up to date and pay all fees outstanding. The draft partial revocation order should include a condition that the applicant will obtain and provide upon request to the principal regulator signed acknowledgments from all participants in the proposed trades stating that the issuance of a partial revocation does not guarantee the issuance of a full revocation, and a condition that the issuer will provide copies of the FFCTO and partial revocation orders to all participants in the proposed trades. Following the completion of the trades permitted by the partial revocation order, securities of the issuer will remain subject to the FFCTO until a full revocation is granted. Now that we've talked about cease-rate orders, we'll move on to recent initiatives.
Thanks, Ray. So in terms of recent initiatives, the first is in relation to venture issuer regulations, which includes amendments to National Instrument 51-102, National Instrument 41-101, and National Instrument 52-110. The substance and purpose of the amendment was to focus the disclosure of venture issuers on information that reflects the needs and expectations of venture issuer investors and to modify disclosure obligations that may be less valuable to those investors. The amendments were also intended to streamline the disclosure requirements for venture issuers to allow management of these issuers to focus on the growth of their business and to enhance the substantive governance requirements for venture issuers. This slide summarizes the changes made as a result of the Venture Issuer Regulation project, and I'll discuss these in more depth in the following slides. So the first noteworthy change relates to Interim Mdna. Previously, all issuers were required to file Interim Mdna using Form 51102F1. Under the amendments, venture issuers have the option to fulfill the Interim Mdna requirements by preparing and filing a streamlined disclosure document referred to as quarterly highlights. This would apply in each of the first quarters of the fiscal year. It is important to note that this is optional. Venture issuers could alternatively choose to comply with the full Interim Mdna requirement. So what are quarterly highlights? It is a short discussion of all material information about your company's operations, liquidity, and capital resources. Items that should be discussed are an analysis of your company's financial condition, financial performance, and cash flows, and any significant factors that have caused period-to-period variations in those measures. Known trends, risks, or demands. Major operating milestones. Commitments, expected or unexpected events, or uncertainties that have materially affected your company's operations, liquidity, and capital resources in the interim period, or are reasonably likely to have a material effect going forward. Any significant changes from disclosures previously made about how the company was going to use proceeds from any financing and an explanation of variances, and any significant transactions between related parties that occurred in the interim period. What are our expectations for the quarterly highlights? As mentioned earlier, the MD&A is a narrative explanation through the eyes of management about the issuer's performance during the financial period to supplement and complement the financial statements. The MD&A disclosure must be useful and understandable. Whether in preparing a full interim MD&A or quarterly highlights, issuers should avoid boilerplate disclosure where the MD&A merely repeats information from the financial statements. As opposed to the full interim MD&A, which requires updating of each item discussed in the annual MD&A, for the quarterly highlights, provide a short, focused discussion that gives a balanced and accurate picture of the company's business activities during the interim period. The purpose of the quarterly highlights is to provide a brief narrative update about the business activities, financial condition, financial performance, and cash flow of the company. While summaries are to be clear and concise, they are subject to the normal prohibitions against false and misleading statements. The second change is with respect to the Business Acquisition Report, or the BAR. All issuers must file a BAR within 75 days of a significant acquisition. The BAR must include audited financial statements for the most recent financial year and pro forma financial statements. Prior to the amendments for venture issuers, an acquisition was significant if the asset or investment test specified in Part 8 of National Instrument 51102 was satisfied at the 40% level. Under the amendments, the threshold for venture issuers has increased from 40% to 100%, and the requirement that BARs filed by venture issuers must include pro forma financial statements has been eliminated. This would also apply where BAR level disclosure is required. The next change came to executive compensation. So prior to the amendments, all issuers were required to file executive compensation disclosure using Form 51102F6, Statement of Executive Compensation. We introduced an option to allow venture issuers to use a new venture issuer form, Form 51102F6V, which has incorporated the following key changes. It requires the disclosure of only 3 named executive officers instead of 5. It requires the disclosure for only the 2 previous financial years instead of 3. And it eliminates the requirement for venture issuers to calculate and disclose the grant date fair value of stock options and other share-based awards in the summary compensation table. Instead, venture issuers would disclose detailed information about stock options and other equity-based awards issued, held, and exercised. The next change is to the prospectus. The amendment reduces the number of years of audited financial statements required for venture issuers becoming reporting issuers, and that's from 3 to 2 years. It's also meant to harmonize the prospectus disclosure requirements to the amendments to the continuous disclosure requirements for venture issuers. So some of the changes that I just spoke about. And those are allowing venture issuers to use quarterly highlights instead of the existing interim Mdna in their prospectus, allowing venture issuers to comply with executive compensation disclosure requirements using the new amendments, and only requiring the inclusion of bar-level disclosure in a prospectus of a venture issuer where the acquisition is significant at the 100% level. The next change is to the audit committee, and it was to create a new requirement for audit committees to have a majority of independent members. As you know, under previous rules, venture issuers were not subject to any requirements with respect to the composition of the audit committee. We now require venture issuers to have an audit committee consisting of at least 3 members, the majority of whom cannot be executive officers, employees, or control persons of the issuer. This requirement is equivalent to the TSX Venture Exchange requirement under exchange policies. So all of the amendments to the venture issuer reporting, as just described, are currently in effect. So things that we have seen since the new regulations came into effect are that not many venture issuers are making use of the quarterly highlights and are still opting to use the full form. We also see many venture issuers that tend to regurgitate information previously disclosed in the company's AIF or annual MD&A. It's important to note that the interim Mdna should really focus on what happened during the quarter and specifically focus on the material aspects of that. Including pages of additional irrelevant information could cause confusion. So another example of a policy initiative, this time applying to non-venture issuers, is our review of women on boards and in executive officer positions. On September 29, 2016, the OSC published CSA Multilateral Staff Notice 58308. The notice reported on compliance with the corporate governance disclosure requirements in National Instrument 58201 related to women on boards and in executive officer positions. It also reported on year-over-year changes since our first CSA Staff Notice 58307 published on September 28, 2015. The objectives of the requirements are to increase transparency for investors and other stakeholders to assist in voting and investment decisions and to encourage more effective boards and better corporate decision making. The corporate governance disclosure requirements relating to women on boards in National Instrument 58201 apply to non-venture issuers. The corporate governance disclosure requirements related to women on boards and in executive officer positions generally take a comply or explain approach. So non-venture issuers must disclose the number and percentage of women on boards and in executive officer positions, whether they have board term limits or other board renewal practices or reasons for not adopting them, details of their written policy concerning the representation of women on their board and in executive officer positions, or reasons for not adopting a written policy. How the representation of women is considered in both director identification and selection process and in executive officer appoints, or if it is not considered, the reasons why not. Whether board and executive officer targets have been adopted, and if not, why not. Some of the key findings from this review are: the number of women on boards has increased in all size categories of issuers, with large issuers still leading the way. 55% of issuers have at least one woman on their board, a 6% increase from last year's results. The number of issuers having at least one female executive officer has remained relatively stable since last year. Women hold 12% of all board seats of the issuers that we reviewed compared to 11% last year. This translated into an increase of 47 board seats occupied by women over the last year. And lastly, 521 board seats became available during the year and were either filled by a new person or left vacant. Of these available seats, only 15% were filled by women. So now we're going to move on to upcoming projects.
Okay, for our last topic today, we just wanted to mention briefly that the CSA's 2016 to 2019 business plan included as a key priority the review of regulatory burden for reporting issuers to identify areas that would benefit from a reduction of any undue regulatory burden, and to seek to streamline these requirements without reducing investor protection or the efficiency of markets. Securities regulators are facing growing pressures to respond appropriately to market issues while avoiding overregulation. While regulators have always focused on the need for regulatory balance, that focus has been magnified by the current market environment, which has impacted many market participants. The CSA has completed several policy initiatives recently to support the public market. For example, the CSA has liberalized the prospectus marketing regime by increasing the range of permissible pre-marketing and marketing activities in connection with public offerings, introduced new exemptions for use by reporting issuers, and amended or harmonized certain existing prospectus exemptions available to reporting issuers, and as Maria mentioned earlier, tailored disclosure and other requirements to benefit venture issuers in the prospectus, continuous disclosure, and governance regimes. The CSA is also currently working on ongoing initiatives, including the review of current resale regime for prospectus-exempt securities and the creation of a national filing system to replace the core CSA national systems. So that concludes the main topics for today's presentation. Please submit any questions that you have for us. Before we proceed to the Q&A, I'd like to draw your attention quickly to the appendix in our slide deck. This contains useful references relating to today's topics, as well as general contact information and contact information specifically for today's presenters. So thank you very much for joining us.